So, let us now get started. It is my great pleasure to hand over the stage to our host, the chairman of the European Insurance and Occupational Pensions Authority, Gabriel Bernardino. Welcome. The floor is yours.
Good morning, ladies and gentlemen, and thank you very much, Melinda. It's a particular pleasure, of course, to welcome you to this 7th annual conference of EIOPA, and of course, to welcome our distinguished speakers and panelists. And it is, I think, also a particular privilege to realize that this EIOPA annual conference established definitely itself as a reference point in the debate of issues about pensions and insurance. I would also like to extend my gratitude, as always, to the city of Frankfurt and the state of Hessen for their continuous support. I'm sorry, guys, for the decision the other day. Congratulations to Paris. But for the colleagues of the city and the state of Hessen, don't despair. Insurance and pensions have a much higher growth potential. So Frankfurt is definitely the hub of the EU supervision of banks, insurers, and occupational pensions, and EIOPA enjoys a lot to be a part of the city. This year's conference program is dedicated to the theme Insurance and Pensions Reloaded. We live in an age of artificial intelligence, with computer science developing intelligent agents, meaning devices that perceive its environment and take actions that maximize its chance of success at some goal. So as humans, we should also be capable to refresh our ideas, rethink our path, and perceive our environment in order to take actions that maximize our chance of building a successful insurance and pensions market for the benefit of our society and our citizens. To help us reloading, we have today 3 fantastic panels touching on issues that are on the top of our agenda. Supervisory convergence, looking back to look ahead. How can the pan-European personal pension product work for the European citizens? And how can regulation enable innovation? I'm sure that we will see interesting debates and a challenging confrontation of ideas. That's the purpose of today's meeting. In my intervention, I will touch upon 4 main areas that cross over the main strategic priorities of EIOPA. Firstly, maintaining sound regulation in an evolving landscape. Secondly, supervisory convergence and the building up of a common European supervisory culture. Thirdly, reinforcing consumer protection in a digital age. And finally, fourth, preserving stability in an uncertain world. Let me start with maintaining sound regulation in an evolving landscape. The implementation of Solvency II was a success for the financial stability of the European system. In a very difficult macroeconomic environment, with historical low interest rates and unprecedented quantitative easing by central banks, Solvency II implementation was carried out smoothly due to timely preparation, proportionate approaches, and adequate transitional periods. And ladies and gentlemen, this is of great importance, because we're talking about an industry that invests more than 11 trillion euros of assets. Overall, the European Union insurance sector is adequately capitalized. Specific transition periods are used mostly by life insurance companies with long-term guarantee business. Transitional measures are intended to limit procyclicality and facilitate the entry into the new regime by giving companies time to adapt and implement the necessary structural reforms in their business. I continue to believe that this transparent and constrained forbearance is an appropriate way to balance micro and macro prudential considerations. Moreover, the European insurance industry is much stronger with Solvency II. It is stronger because it has capital better aligned to the risks it runs, because it uses a more realistic basis to assess and mitigate risks, and thus can better price them, because it has upgraded its governance models with a complete different emphasis on the role of the boards, the setting up of key functions, and the implementation of a own risk and solvency assessment, the ORSA. With Solvency II, we also have the basis for a more transparent industry with harmonized templates for supervisory reporting and enhanced public disclosure. But the insurance business is complex. It's complex in the scope of the risks, in the interaction with financial markets, and in the contractual relationship with policyholders. There is no free lunch. Solvency II, as a risk-based regime, needs to capture, to some degree, the underlying complexity of the business and then try to strike the right balance. 10 years after the emergence of the financial crisis, we live now a different phase of the regulatory cycle, naturally influenced by the new political priorities of increasing investment and economic growth. While in my view it makes perfect sense to evaluate and review the recent reforms in order to mitigate any unintended consequences and increase proportionality, I also strongly believe that we should not abandon the core values of stability and consumer protection that presided over these reforms. We cannot forget that the post-crisis regulatory agenda was the right response to restore the loss of confidence in the financial sector. To build up sustainable long-term investment and economic growth, we need a stable and strong insurance and pension sector that adequately prices risks, applies robust risk management strategies, and treats customers fairly. Despite the fact that we just start to witness the benefits of Solvency II reforms, we are already reviewing the regime with a focus on reducing complexity and increasing proportionality. Recently, EIOPA advised the European Commission to adopt simplified calculations on the solvency capital requirement standard formula for risks such as lapse and mortality, and to reduce over-reliance of insurance undertakings on external credit ratings applying simplified calculations. In order to finalize the second phase of our advice, which is scheduled for February, EIOPA recently consulted on other overarching aspects of the SCR standard formula, getting stakeholder feedback on key modules such as the loss-absorbing capacity of deferred taxes, non-life and life underwriting risks, catastrophe risks, unrated debt and unlisted equity, and other topics such as the cost of capital in the calculation of the risk margin. Building up evidence and knowledge towards the 2021 overall review, EIOPA is definitely attentive to the different impacts on the market. The recent investment survey that we have done points out, of course, to a search for yield behavior of insurers, which we believe is a natural reaction to the low interest rate environment. The increased exposure to more illiquid investments and to non-traditional asset classes such as infrastructure improves asset diversification, but also demands new risk management capabilities from insurers and closer supervisory scrutiny. At the same time, in line with our expectations, the first observations from the impact of Solvency II point to an increase in long-term investment and a stable allocation to equities. Another consequence of the low interest rate environment is the acceleration of the pace of change in business models, especially in life insurance, with a move towards contracts with lower and more flexible guarantees, and in some countries, the significant increase of pure unit-linked products. While this is a natural management reaction to ensure the long-term sustainability of the insurer's commitments, and of course, also, let's be honest, optimize capital in a Solvency II environment, it also increases the transfer of risks towards policyholders. I believe that this last evolution deserves further reflection from a regulatory perspective. We should use the development of the PEP and the 2021 Solvency II review to thoroughly analyze the new evidence available on the risks and characteristics of long-term life insurance products, especially concerning the illiquidity characteristics of the liabilities and the corresponding ability of insurers to mitigate short-term volatility by holding assets throughout the duration of the commitments, even in times of stress. In the coming weeks, I will propose to my board the setup of a specific work stream to analyze these issues and maintaining the sound market consistent orientation and the principles of policyholder protection in Solvency II to explore the development of a specific regulatory treatment to the spread and equity risk charges associated to long-term assets that back certain type of truly long-term illiquid liabilities. The intention should be to propose a regime that would better recognize the true risks of long-term, transparent, risk-sharing products for the benefit of consumers and the whole economy. But regulation is also on the move internationally. I am particularly pleased with the recent progress achieved at the International Association of Insurance Supervisors regarding the development of an insurance capital standard. We are now a step closer to the emergence of a truly sound and robust group solvency regime that should be applied by all jurisdictions throughout the world. Back to the European Financial Services Agenda. An important project is, of course, the development of the Capital Markets Union, and in particular, the proposed regulation on the PEP. The European Commission proposal builds up on EIOPA's advice, and I must say it's a brave step towards the establishment of a European, safe, transparent, and cost-effective long-term retirement savings option that will offer young generations of European citizens an entirely new personal pension framework to save for an adequate future retirement income. I'm confident that the co-legislators, the European Parliament and the European Council, will recognize the strategic importance of this initiative for the EU citizens and will contribute to even improve it and deliver a successful product. I welcome the proposal that EIOPA plays a key role in enabling consistent implementation and EU-wide consistent authorization requirements to safeguard the proper use of the PEP label and ensure high-quality PEPs throughout Europe. Furthermore, EIOPA's mandate to promote supervisory convergence is of paramount importance for the trust and confidence in the PEP. In my view, a stronger coordination through the development of supervisory plans for PEPs is needed to support the initiative of a truly European product. To strengthen the transparency of PEP's supervision towards EU consumers, I would propose that EIOPA should be mandated to publish an annual report on the PEP supervision activities performed throughout Europe. For EIOPA, standardized, comparable, and relevant information about available PEP needs to be easily accessible to consumers to help them to make well-informed and conscious decisions about their plans to save for retirement. The information about PEPs needs to be relevant. Therefore, further development of pension-related consumer-friendly disclosures for the pre-contractual and the regular benefit statements is needed. EIOPA welcomes the initiative by the European Commission to collect, analyze, and report on costs and performance indicators for the main long-term investment, personal, and pension products. And the outcomes of this initiative will definitely enhance the proposed disclosure requirements for the PEP. In light of the current economic environment and the challenges faced by products with long-term obligations, the design of the default investment option will, to a significant extent, determine the success of the PEP. Taking all elements into account, and in order to ensure that the PEP is a truly pension product, that there is an adequate protection of savers, and that they will benefit from successful long-term investment strategies, it is my personal view that the default option should include a requirement that all paid-in contributions should be guaranteed only at the point of decumulation. And that also the default option should specify the default conversion of a significant part of the accumulated amount into programmed withdrawals or annuities, protecting savers against longevity risk. Finally, I believe that more flexibility is needed to minimize the burden of the mandatory rules on national compartments. Let me turn now to supervisory convergence and the building up of a common European supervisory culture. In the coming 3 years, one of EIOPA's key priorities is to further enhance supervisory convergence, with the aim to move towards a common European supervisory culture. A risk-based culture that aims to ensure strong but fair supervision, that is based on a forward-looking and proportionate approach to risks, that takes into account that it's always better to prevent than repair, that prioritizes the dialogue with market participants in order to better understand their business models, strategies, and underlying risks, that applies professional skepticism and a challenging attitude, that promotes early enough awareness and supervisory action in order to protect policyholders and mitigate possible disruptions in the market. Today, I'm particularly pleased to announce that the EIOPA's Board of Supervisors unanimously approved the booklet that you find on your folder about a common European supervisory culture. This is the result of a joint and common effort, and I would really like to thank all the board members and the colleagues that have worked in this document. It outlines the most important elements of high quality and effective supervision, ranging from the principles that underpin a common European supervisory culture to the basic conditions and tools needed. This common supervisory culture supports the development of a EIOPA supervisory handbook that contains good practices to be followed by supervisory authorities to achieve pan-European risk-based, proportionate, and preventive supervision. The handbook addresses the main elements of the Solvency II framework and provides recommendations, practical examples, case studies, and risk indicators. Let's face it, a common supervisory culture cannot be built overnight. But by working together, step by step, focused and challenging each other along the way, we can build a strong and fair supervisory culture that promotes consumer protection and enhances the stability of the financial system for the benefit of Europe's business, economy, and citizens. Due to the internal market and to the cross-border activities, the quality of national supervision is no longer solely a national issue. It is a European issue. Day-to-day supervision, as you know, remains a responsibility of national competent authorities. EIOPA's supervisory convergence agenda is focused on building common standards and interpretations, on leveraging data for risk assessment and supervisory purposes, on monitoring common standards, and challenging and supporting national supervisor authorities. We are using a number of EU-wide and cross-border tools to detect and mitigate risks. For example, we have access via central data repository to all individual undertakings supervisory reporting. This allows us to analyze and assess the national insurance market's risks from a European perspective, but also to add value and efficiency to supervision. We know that different approaches in national supervisory practices can potentially result in significant differences in capital requirements or even cause undertakings to limit the geographical scope of their group internal models. Also, policyholder protection can be at stake if internal models allow weak calibrations. An important tool to address these inconsistencies and potential threats are the dedicated European Union-wide consistency projects that we are running. Through these projects, we are collecting required information and thoroughly studying the issues in detail. And as a result, we can take appropriate remedial actions, for instance, in the form of supervisory opinions. As an additional tool, EIOPA is using peer reviews to get an insight into how national supervisors apply, for example, the proportionality principle. For instance, when supervising undertakings' key functions. These reviews will result in concrete recommendations to address the issues identified and to develop best practices. To address imminent issues where cross-border risks following branching out of freedom to provide services are identified, EIOPA has developed the so-called cooperation platforms. Several platforms have been set up during 2017 with a noticeable impact on the cooperation between national supervisory authorities, home and host, and coordinating their actions. The increased cooperation has sped up the process and identification of an assessment of risks in the market with a significant impact on both home and host authorities. For the home authority, some of the firms providing services were operating below the radar, smaller firms with no direct impact on their markets. Raising the attention to EU-wide risks and the potential consequences they have for the home authority has in many cases led to direct intensified supervision and the more proper identification of the risks coming from the host markets. For host authorities, the cooperation platform has provided the opportunity to raise concerns on the protection of the policyholders in their jurisdictions. Instead of being informed when a license is withdrawn or a company is put into liquidation, the host authority is much earlier and better informed. This process can only be led and supported by an authority that takes the interests of the whole EU policyholders and that steers its action with this objective in mind. The first results of the cooperation platforms in 2017 have been very encouraging, and the tool has been embraced by the supervisory community as a welcome addition to the toolbox of supervisory convergence. Besides the EU-wide cross-border tools, EIOPA actively uses bilateral engagements with national authorities. These are, of course, tailored to the national specificities following the diagnosis and the analysis of the national markets and the relevant cross-border activities. As an outcome of these bilateral engagements, EIOPA is updating accordingly its risk assessment on the market and the level of supervision, providing independent and challenging feedback. Specific follow-ups from bilateral engagements have, for instance, been extensively used in Romania and Bulgaria with their balance sheet reviews. EIOPA has played an important role in these reviews, being an active member on the steering committee of the exercises and focusing on supervisory actions to be followed on the findings. One of the key elements of the common supervisory culture that I mentioned is to be conclusive as supervisors, to take actions and control when issues are surfacing. And definitely EIOPA is taking a leading role in this area. The initial first impacts of these reviews, where some immediate effect on firms and market practices are noticeable, have been followed up by further ongoing intensive cooperation with the local supervisory authorities. But the emphasis on achieving supervisory convergence is also reflected in the European Commission proposal for the review of the EIOPA's regulation. We strongly welcome the proposal and believe that EIOPA's stronger mandate to ensure convergence in supervisory practices, to the development of strategic supervisory plans and the empowerment to undertake independent assessments of internal models are clearly steps in the right direction. Nevertheless, we consider there are still issues that deserve some fine-tuning. Let me mention just two areas. First, we believe that our regulations should be strengthened with a mandate to act more intrusively when we detect signals of risks of cross-border failures. And in order to allow us to act in a preventive manner, national authorities should be mandated to notify EIOPA early enough in case insurance companies experience deteriorating financial conditions with possible cross-border effects. Second, EIOPA's role with regard to supervisory independence and conflicts of interest should also be strengthened. These fundamental supervisory principles have gained even more relevance under Solvency II due to the degree of supervisory judgment necessary in the application of a risk-based regime. It is fundamental that national supervisors are operationally independent and that they are accountable for the exercise of their functions and powers. The operational independence, transparency, and accountability of national supervisors needs to be reinforced with the establishment of a strong European framework and a clear role for EIOPA in assessing its implementation. Let me now turn to the area of consumer protection in a digital age. As we know, the conduct of business reforms brought by the Insurance Distribution Directive and the PRIIPs regulation are about to be implemented. Recognizing the difficulties in making progress in a very sensitive area, this is a significant milestone in further promoting a consistent approach towards consumer protection in Europe. The supervision and enforcement of the IDD requirements is fundamental to ensure that we achieve the intended increase in the protection of consumers. We know that insurance distribution have different nuances in different member states, with diverse models relying on a different extent on agents, brokers, and intermediaries like banks. Moreover, there are different supervisory approaches and variations of what constitutes a suitable and proportionate mix of off-site and on-site activities. EIOPA will be particularly interested in understanding how, in practice, the different national competent authorities intend to supervise and enforce the IDD requirements, namely the product oversight and governance and the conflict of interest rules. These areas, combined with the implementation of the PRIIPs regulation, will definitely require that national authorities put in place effective market monitoring activities to develop a deep understanding of the products sold and assess their respective selling practices. A benchmark for conduct of business supervision practices should emerge in the internal market. But we maintain a forward-looking perspective to regulation and supervision, trying to identify significant trends that can affect the markets and consumers. And in this sense, the growing use of new technologies, digitalization, big data, and machine learning have the potential to change significantly the insurance value chain, creating new opportunities to improve customer experience and generate lower costs, but also bringing up new risks. We take definitely a strategic approach to InsurTech. And for 2018, our three main priorities will be the use of big data by insurers, where we will run an EU thematic review, the mapping of supervisory approaches to innovation, where we'll find out about the sandbox and innovation hubs put in place in different member states, and thirdly, cyber risk, both from the angle of insurers' cybersecurity and the insurance sector as an underwriter of cyber risk. We believe that insurance regulation needs to be technological neutral, but at the same time, should not create artificial obstacles that will hinder innovation and limit the potential to build better products and services for consumers. Furthermore, if we want to have startups in Europe growing and scaling up within the internal market, we need to be very attentive to the possible proliferation of very different national approaches to innovation. Going forward, let me mention a couple of provoking questions that should deserve our prospective attention and debate. Is there a need to move towards an activities-based regulation to ensure that all kinds of players, be it risk carriers or intermediaries, are captured by the regulatory framework, and that the requirements on the provision of information to consumers are technological neutral? Is it time to start to be concerned with ethical issues surrounding the use of sophisticated algorithms for insurance pricing? Shouldn't we devote more attention to the emergence of new possible sources of systemic risk, like cyber incidents amplified to the exponential interlinkages between big technological providers and the whole financial sector, as is the case of the usage of the clouds? Is the future of insurance, as some say, to be mostly transformed in a service-oriented tool designed to prevent risk more than to pay claims? Will we end up with only a small number of truly risk carriers with huge balance sheets to cover tail risks? I know that these are provoking questions, but one thing is for sure. In an ever-challenging and changing landscape, we know that what worked in the past does not necessarily work in the future. So as insurance providers adapt to changing environments, it is always important to remember the needs of consumers and to make sure that their rights are always respected and their needs always addressed. This is as relevant today as it was 70 years ago, and I'm certain that this will be still true 70 years down the road. Finally, on preserving stability in this uncertain world. One of the lessons that we learned from the recent financial crisis is the need to have in place adequately recovery and resolution tools, which will enable national authorities to intervene in failing institutions and resolve failures in an effective and orderly manner. At present, as you know, there is no harmonized recovery and resolution approach for insurers in the EU, and the emergence of national specific solutions will only increase fragmentation in the internal market and create additional difficulties when dealing with cross-border cases. To reduce this risk, to avoid unnecessary economic costs stemming from uncoordinated decision-making, and to ensure orderly resolution, European action is required. Therefore, in July, EIOPA published an opinion calling for a minimum degree of harmonization in the field of recovery and resolution for insurers, consisting of 4 building blocks: preparation and planning, early intervention, resolution, and cross-border cooperation and coordination. Furthermore, this framework should be aligned with Solvency II and be applied in a proportionate manner. Although the introduction of Solvency II, and in particularly the adoption of risk-based capital requirements and forward-looking supervision should contribute to reduce the likelihood of insurance failures, it is important to realize that Solvency II is not a zero-failure regime, and eventually failures will continue to occur. Beyond recovery and resolution regimes, insurance guarantee schemes can contribute to increase the overall protection of policyholders and beneficiaries. However, in the European Union, this area is still significantly fragmented, with the existing schemes differing quite substantially in terms of financing, functions, mandate, and coverage. This fragmentation creates particular problems in the presence of failures involving cross-border business. So I believe that in the medium term, it is fundamental, both for consumer protection and for the proper functioning of the internal market, to build a minimum harmonized approach to national insurance guarantee schemes in the EU. As indicated in its regulation, EIOPA will start to assess the need for such a framework and intends to issue a discussion paper during 2018. Of course, we continue to assess the resilience of insurance and pension fund sectors to adverse market developments through the regular setting up of stress tests. Before the end of this year, EIOPA will publish the results of our 2017 occupational pension stress test. A stable financial system relies on all of us staying alert to emerging developments. For instance, regarding the UK's decision to withdraw from the EU, EIOPA published, as you know, an opinion to support national supervisory authorities in order to secure sound and convergent practices linked to the relocation of UK-based undertakings into the EU 27. Sound supervision demands appropriate location of management and key functions, and empty shells or letterboxes definitely should not be acceptable. We are now in the process of monitoring the implementation of these principles by the national authorities in concrete authorization processes. But let me go a little bit beyond. Assuming a Solvency II forward-looking perspective, I believe that it is now more than time, and it's crucial that all insurance groups throughout Europe properly assess the risk of a cliff edge scenario to their business and consider all possible solutions to mitigate them under the available regulatory framework. Also, national competent authorities should encourage appropriate contingency planning by groups, and they should be prepared to review them and to take the necessary decisions. To conclude, ladies and gentlemen, the post-crisis regulatory reforms were designed to build more stable and fair and transparent financial markets, along with stronger and better governed players. I think that we are in a good track on this. So it's now time to benefit from those reforms and ensure that financial institutions have a role to play in solving emerging societal gaps, such as the long-term savings and the natural catastrophe protection gaps. It is imperative the development of intelligent solutions for these gaps, and all of us need to make a contribution. As a famous futurist recently said, what we should be more concerned about is not necessarily the exponential change in artificial intelligence or robotics, but about the stagnant response in human intelligence. At EIOPA, we will continue to promote the common public interest that lies behind geographical boundaries and cultural differences, strengthening supervisory convergence in order to fulfill our mandate of policyholder protection and financial stability in the European Union. Thank you for your attention.
Thank you very much, Chairman Bernardino.